Hi, this is Michael Neuenschwander with Outlook Wealth Advisors, CPA as well as Certified Financial Planner. In a previous video, we talked to you about whether Roth conversions make sense. We gave an example of, a 64-year-old with 1.4 million, but really gave you the framework of how to think about Roth conversions. Well, today I want to share with you some hacks, some strategies on how to pay the taxes on that Roth conversion. Because unfortunately, as we touched on, the one negative of the Roth conversions is you are obligated to ultimately pay that tax. Now, the way the IRS looks at taxes may be a little different than what you thought. Generally, they go under what they call a pay-as-you-go type of strategy, meaning they're expecting you to pay evenly throughout the year. Well, when you do a Roth conversion, oftentimes you're not doing it evenly throughout the year. Many people prefer to do the Roth conversion early in the year to say, well, hey, I think the market's going to work. We're going to have a good year. Let me get that Roth conversion done early. And if I can, let me pay the taxes at the end of the year. Well, that strategy potentially leaves you open to having to pay some penalties because the IRS was expecting it all throughout the year. So what can you do about it? Well, let's first talk about what's the ideal way to pay those taxes in the beginning and where should that money come from. So in a perfect world, you could say, can I do a Roth conversion and pay the taxes with the money I have elsewhere? So for example, if you were going to convert there's 50,000 or 500,000 out of your IRA, it says, suppose I moved that money into my Roth early in the year. And I want to get as much money into the Roth as possible, so I put the entire 50, or in this case, $500,000 into a Roth, but based on your tax bracket, you're going to owe, 24% on that money. So you've got to come up with potentially almost $100,000 that may be due in taxes. Well, how do you do it? Well, if you have enough assets saved aside, it's great. I got the whole $500,000 into the Roth IRA. I'm just going to pay that $100,000 with cash in the bank, money out of a brokerage account, and so forth. That's the ideal because you're getting all of that Roth money 100% from the taxable IRA side, now fully growing for you 100% tax-free within the Roth. However, the reality is for most people, I don't just have an extra $100,000 sitting around in a non-retirement account that I want to give to the IRS. So for a lot of people, you have to ultimately say, I got to take some of that money out of the IRA to pay it. Well, here's where a couple of different hacks, different strategies we can touch on come into play. So as you do a Roth conversion, as I mentioned, the IRS operates under a pay-as-you-go strategy. So whether you did a Roth conversion at the beginning of the year, end of the year, you're going to get a tax statement that says you converted, let's go back, $500,000. So that's going to show as taxable income. Now, the IRS is going to look and say, well, when did you give us the money? And on $500,000, they would have expected, did you pay them $25,000 a quarter roughly over the entire year? Well, suppose you did that Roth conversion in December. Well, you certainly didn't pay them $25,000 all 4 quarters all throughout the year evenly. Well, there is sort of a get-out-of-jail-free card on that. That's Form 2210. What that form really does is you're telling the IRS when you had income throughout the year. So in this case, you would say, I didn't have high income all throughout the year. I only had high income in the 4th quarter when I did a Roth conversion. And then if you make your estimated tax payment, in this case in January, as your 4th quarter payment, that helps reduce or ideally eliminate those tax penalties altogether. The issue is if you don't know to complete that form, you're going to get stuck with penalties and interest for underpayment, even though you technically, if you paid in the 4th quarter, paid at the time you did the Roth conversion. So that's one way to avoid, taxes and extra penalties on Roth conversions. Another way to avoid those penalties, interest, though, is to actually pay the taxes out of the IRA. And there's a couple of different ways to do it, as well as some gotchas, some things you need to know. So when you do a Roth conversion, if you pay the money with IRA money, so in that case I was using earlier, if someone were to convert $500,000, $400,000 would make it into the Roth itself. The extra $100,000 would go out to the IRS as tax withholding. The good news on tax withholding, however, the IRS does not keep track of when they get tax withholding. So in that case, if you did your Roth conversion at the end of the year, withholding automatically went in. You don't need to worry about interest and penalties so long as you got the right amount paid in to begin with. Same applies though at the beginning of the year. However, here's where we don't necessarily want to give the IRS money early. Suppose you did that Roth conversion in January. You could go ahead and make that payment in January to the IRS. The Roth conversion's done, they get their money early in the year. However, you could also simply do the Roth conversion in January, put the whole $400,000 in this case into the Roth IRA, and do a second distribution from the IRA in December, and then do it as 100% withholding. In that case, still no interest and penalties as long as it's done as withholding from the IRA. As I said, the IRS doesn't keep track of exactly when they get withholding. They deem it to have been paid evenly throughout the year. So that's another strategy that can keep more of your money working for you for those other 11 months and ultimately still get it to the IRS without making quarterly payments and without having to give it to them early in the year. One word of warning though. Many people sometimes try to do Roth conversions or figure it out themselves, or they do a Roth conversion from their 401k. Oftentimes that can be a mistake. Distributions from 401ks typically have a mandatory 20% withholding. So if 20% is not the right number, well, then you may be giving the IRS too little or too much. Likewise, when that's done as part of a Roth conversion, some 401ks have no provision to actually do the actual withholding as part of the Roth conversion. You have to do a second distribution to do it. Or in the case we talked about, if your preferred method would be I want to do the conversion early in the year and pay the taxes later in the year, oftentimes 401ks don't give you the ability to do that. So before you run and try to do the Roth conversions or determine the best tax strategy, make sure, are you doing it in your IRA or are you doing it in the 401k? And if you're doing it in the 401k, make sure you understand the rules of your individual 401k plan. But now one extra special hack for paying those taxes later in the year. Suppose you have the money in a brokerage bank account, so you want to get the full amount into the Roth and you're just going to pay the taxes with other money. But you want to do that Roth conversion early in the year, but you also don't want to send the money in quarterly to the IRS. We can use one special provision called the 60-day rollover rule. What that allows you to do is, just like before, do the conversion from your IRA, do the conversion early in the year, do a second distribution later in the year and send that 100% to the IRS. But now take that money you had in your brokerage account and put it back into your IRA. If that's done within 60 days, the IRS treats that as a 60-day rollover, and it's as if that distribution never took place for tax purposes. But in fact, the IRS got the money via withholding, not via estimated tax payments. So there's another way to sort of leverage the rules of the IRS to work in your favor when it comes to paying those taxes on the Roth conversions. One last strategy for those of you that are charitably inclined as well. When you really look at your taxes and say, are you able to itemize deductions based on what you're giving to church or charity? If you are and you're significantly above the standard deduction every single year, that's terrific. But for many people, when the standard deduction is almost $32,000 for a married couple age 65 and up, it's hard to get over that standard deduction every single year. You potentially could be a candidate for what's called a donor advised or a charitable fund that allows you to stack your charitable donations up. And in doing so, you may be able to create a large one-time deduction to offset that Roth conversion. So ultimately, not only do you have a strategy for giving the IRS the money they're due as late as possible, but perhaps you don't need to give them as much of it to begin with. So pairing these strategies up is what we would call tax planning in retirement. So if this has been good information to you, if we've shared a few strategies maybe you hadn't thought of before, make sure you subscribe below. If you didn't catch our earlier video when we talked about what are the thought process to go through a Roth conversion and does it potentially make sense for you, again, go back, catch that other video. If this information is helpful and you'd like more information like this when it comes to retirement and tax strategy, make sure to stick with us and enjoy the upcoming videos. Thanks a lot.